Hi, I'm going to run through a program called the Child Millionaire. It's an option of parents and grandparents and great grandparents to save for the children in their lives. And so I wanted to jump to this program that was created by some of my colleagues, and we're just going to run through some scenarios. Sorry, I didn't get it on the right screen here. Um, we're going to use an example of a monthly contribution to a dividend paying whole life insurance policy and show the power of this savings, right? So we're going to start with contributing $250 a month, which is $3,000 a year. And we're going to show initially what it would be like if you had been doing that from age, basically 0 or 1 to 20. Uh, these are averages from across multiple products, whole life products from multiple insurance companies. Um, Recently, I ran one on a 4-month-old, and by the time they're 20, it was over 70,000. It was about 71,000. But that's not really the point of this. This is showing the power of not only saving but having access or ability to collateralize this using the infinite banking concept. But 68,000 at age 20, if you put $250 a month in, at age 65, it's projected with dividends, which is not guaranteed, but um, certainly, you know, the insurance companies that I use have been in business for over 100 years, and they've been paying dividends for that whole time. So at 65, in this case, you have 606,000. At age 75, you'd have 950. Now, I'm going to show some of these things on the screen. Total contribution is 60,000. That's because of the 20 years. Obviously, you're contributing more, or more is being uh, put into the policy. In this case, it would be 3,000 times 65 years, because that's when um, these policies are paid up. Okay, so between 65 and 75, in this case, there was no contributions, and there was nearly 350,000 that was generated. So that gives you an idea of the growth. And then we use some examples of particular times in your life that you might want to do things with the money that you've been putting away. The other thing that I want to say before I move on to that is uh, there's, in most cases, not a better time to put an insurance policy on a child, because they're very healthy. It's easy. As long as the parents have life insurance, it's easy to get life insurance put on a child, and it guarantees their insurability. And there is an option on these policies to add a rider that would allow you at different times in your life to add additional life insurance without having to prove your insurability. So, God forbid, something happens to the health and typically would make them uninsurable. This guarantees that they'll be insurable and they'll be able to put this money away. So we're going to just jump to, what happens when you build up this cash value and what options you have. And in this program, all they're showing is at age 20, you'd have 62,000. And in this case, they decided to take out a loan from the insurance company, leveraging this 62,000 in collateral, um, and putting that away each year with a product, a vehicle, an investment vehicle that's returning 6% interest. So from year 20, age 20 to year 50, age 70, this $3,000 a year investment, which you can pay back, um, to the insurance company and the loan that you've taken, but you aren't required to. But regardless, this is the kind of interest that would be earned on that investment. Um, of $3,000 a year for 50 years, which, as we know, is 150,000. Now, your interest earned is 773,000, which in fact turns this into this 926. So you get your principal back and you get this 773,000. So that's just one example of what you could do if you had put some money away for this child. Um, and they, okay, so we've got the 926,000, but that doesn't really change anything. Well, it doesn't change it at all. So this is going to adjust a little bit. It's taking some time. So this, 950,000, that's inside the policy. This number over here is what we call, you know, uh, active, you know, cash flow that has been created from this other investment of 926,000. Now, because you didn't take your own money out of the policy, you still have money that's going in and growing within the policy. So you have that 900 at 75 years old from the previous page, plus you have this 926. And then the American dream is still alive, which one of those dreams is to own your own home. And what we're describing here is, well, at age 30, I want to start a family, buy a home um, with my wife or my husband, and I have access leveraging 97,000 at this point, um, and I have enough money to go and put a 10% down payment on a $350,000 house. Now, let's say that house is, 500,000. I still have the money. Let's say that money, that home is let's say 650,000. I still have the down payment of 10%. And let's say that home appreciates at 2.45%, which is a pretty standard inflation target. So when you turn, 70 years old, not only do you have that other investment, for the $3,000 a month that made 900, you still have 900,000 potentially available in your cash value. We can get into the particulars, but without complicating it, now this home that you purchased at age 30, at age 70, it's worth 1.7 million. And then we say, well, okay, 10 years later, after taking out the mortgage on our home, we decide we want to buy an income property, maybe a vacation slash income property, right? So as long as you're renting it out a certain part of the year, you can also use it for yourself as a vacation home. The purchase price at that time was 350,000, and then you got rent income annually of $12,000. So you're generating 360 over a 30-year period. And again, that home turned from 350, worth 650. So now you have another $1 million available to you. That is the power of this. You can continue to make, contributions to these. You could take this at age 50. Now you've got, and I can tell you, the policy that I talked about earlier, it's a lot higher than 261,000. It's actually at age 50, it's 455,000 on a 4-month-old little girl. So by the time she's 50, she's projected to have 455,000. Now that's not guaranteed, but these dividends are being paid currently at those rates. Things could change. They could go down or they could go up. So it could be a little bit less or it could be a little bit more. But regardless, even today, what I'm running, it's showing a 50-year-old baby will be have access to 455,000. Let's just stick with this story, right? So now you take for the next 20 years until you're 70, you're putting this into a vehicle that's making 6%, which with my life settlements um, opportunity that I refer to a number of solutions. I mean, we can get higher. They can get higher than 6%, or at least they're projecting that, and that's historically they've been doing. Close to double that and more. So, but regardless, we take that 261, we invest it, and we end up with a balance 20 years later of 836,000. Again, pretty conservative. So, just wanted to run this really quick. I didn't want to go on and on, but there is a lot of value. You can leave a legacy to this child as a grandparent or great grandparent, and eventually you can turn this over for the premiums to the parents, or even the grandchild or this child. So thank you for watching, and I hope you have a great day, and we'll talk to you later.